Hello and welcome to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. It's been a choppy few days in the market for Bitcoin. China released a news story a few days ago that they were banning all cryptocurrency. But seeing as this was the 6th or 7th time that same news story has been released by China in the last few years, the market did not react in the same way as it usually has. Regardless, a lot of fear and uncertainty remains, so I have spent most of this morning looking through the charts and trying to produce a proper bear case for this market, but I keep running into roadblocks. I'll take you through what I'm seeing and we'll talk about it together. If you're enjoying my content, please give this video a thumbs up and make sure to subscribe to my channel. If you turn on the bell icon next to the subscribe button, you'll get told about all videos that I post going forward. As we sit here on the morning of September 26th, we're around $43,300 in price, and we sit atop a large range of volume accumulation that has taken most of the year. Where we can see that volume distributed is on this chart, the realized price distribution. Now this is the volume of all Bitcoin currently circulating, separated by their on-chain cost basis. And by looking at our coins this way, we get an idea of where the most amount of volume and consolidation has been occurring on-chain. Right now, we're sitting at this area here, around 43,000, and you can see there's a big chunk of distributed volume just below us here that represents a large amount of the current holders. We look at this chart just a week ago, we can see that the amount of volume that had consolidated around 47,000 was the highest single area of volume concentration since the price was near 10,000. We reported on this in a previous video, found it very interesting. And now, 1 week later, that volume has distributed itself around the lower 40s. I like to see this kind of distribution. It helps to close in some of the gaps, and we don't get quite as much quick chop in lack of support when price goes diving for a bid. And I do think that were we to make it out of this price range and go upwards, coming back down to this area would find a considerable amount of psychological support. When we look at the entity-adjusted activity on chain, that is the amount of individuals participating in transactions every day and the count of those transactions, we can see that they are still on the lower side. There is a slight trend upward since middle of June, July. It's been on an uptick, but this level still remains considerably lower than where we were in the rage of the bull market. So this does give me pause. This would be a bearish factor on the current market. The trend is positive, but the fact that the volume remains low and the amount of individuals taking part in these transactions remains on the lower end, we can assume that most of the exuberant casual retail that we need to be in this market is still at home. The next chart I want to look at is the 90-day coin days destroyed chart. So coin days destroyed is one of the oldest metrics that we have in Bitcoin analysis. For every day that a coin sits dormant on the network, it accrues one coin day. When that coin is then sold to another buyer, its coin days in total are destroyed. And it gives us an idea of how long those coins sat around. And on the aggregate, we can start to see when a lot of coins are moving that were sitting for a period of time. You can see here the spikes in 90-day coin days destroyed that tend to align with market tops. This is the kind of behavior we've spoken about at length on this channel. Older coins being sold into market strength to realize gains by older, savvier investors. This occurs in all market cycles. There's a burst of volume of older coins being destroyed, being sold to new hands, and then that value resets as older coins begin to become dormant again. We can see over here this year there was a burst of coin days destroyed, but I will note for you that this level of coin days destroyed is nothing compared to all of the previous bull runs. And something else worth considering is that the longer this network exists, the longer that coins are able to sit for years and years, the more coin days conceivably can be destroyed in a given bull run. Back here in 2011, there were not that many coins that were a year old. In 2013, there were not many coins that were 2 years old. Now, in 2021, we have coins that are 10 years old. So this value over here in 2021 of coin days destroyed represents to me that many old hands chose to stay strong. We did see old hands selling. We saw them realizing gains. It did help push up the price, but it wasn't the same kind of exuberant exhaustion of old coins that we have seen in all previous markets. This to me speaks to a bit of a bullish behavior. While we did get the unloading of old coins, which helps to rotate the market and provide that cyclical behavior we're looking for, the fact that it wasn't the same level of coins being moved, it was considerably muted, suggests to me that many of the holders in this current market feel, as I do, that we are not near the end of this market cycle. The next thing I want to look at is supply adjusted dormancy. In the previous video, we talked about dormancy, and it's the average age per unit of BTC that is moved every day. So it's the average age of the coins themselves, and it tends to ignore the volume. So where 90-day coin days destroyed is heavily reliant on volume, the amount of old coins being destroyed and the amount of days held within those coins. Dormancy doesn't care about volume. It's just the average. So you don't get quite the same oscillation up and down, but you do get representation when you see old coins being moved for a period of time. You can see the spikes of these values here in bull runs. It spikes here, it spikes here. There's spikes before and after in 2017 and 2018 because this was just a massive market. And over here in July 2020, you can see this value starts to increase. It increases heavily through January of 2021 of this year, and then it's been in a structural decline ever since. There was a spike here, a burst of volume at the end of the summer when the price really began to rally. There was some coins moved here, but structurally this is in a decline. And now the dormancy values that we're seeing are the lowest values we've seen since before the 2017 bull run. This value here, if I take it straight across, the last time we saw this value was November of 2016. The users on the network are not selling their coins. Every day, the volume of coins that is moving around get younger and younger. This chart is showing you that trend. It makes it hard to propose a realistic scenario that shows that everyone currently holding is going to give up on this asset and begin dumping when they have been in a structural decline of desire to sell throughout this year. Something would have to change their minds considerably, some new factor for this group of holders to shift their behavior. Continuing to build on that point from dormancy is the spent volume age bands chart that many of you are quite familiar with at this point. And I want to reinforce that the volume of coins being spent each day, here being 6-month and older coins only, the volume of those coins being spent every day is in a structural decline. Yes, there was a spike here as we bounced off of the B-word conference and we rallied out of the lows in the summer. There was some coins moved here, but that was it. Otherwise, this is a structural decline ever since January when we hit this top. This is the top we've spoken about at length. This is when old hands relinquished their coins into market strength. This is when miners sold. This is when whales sold. And after this moment is when volume on the network began tapering off. And what carried the rally up here were derivatives traders and the grayscale arbitrage and just a potpourri of other factors that had nothing to do with a proper bull run. Since this moment, old hands have just simply not cared to do anything in terms of spending. Their outflows have been in a structural decline. When we make the argument that old hands are not selling, that they remain strong, that they're not interested in realizing any gains or losses here, those things sound bullish. They sound like the kind of market behavior you want. You want confidence in the people who hold this asset. You want them to hold on to their coins and not try to dump them, because that's how price appreciates and that's how supply remains constricted. But when we look at network activity, it's clear that we're on the lower side. However, despite the evidence suggesting that we are in a bear market, we have low activity, we have low entity counts, we're not seeing very much volume, the mempool remains kind of empty for a lot of the day. Despite all of that, there are several things happening now that are different from previous bull runs and that suggest we have evolved into a new type of market for Bitcoin. The first of those factors is the balance of coins on exchanges. We've talked about this before. In on-chain analysis, a coin being placed on an exchange is a bearish behavior. It makes that coin readily available to be sold with a click of a button. By taking coins off of exchanges, you create a friction in order to sell them. There are steps that have to be taken, including putting them back on an exchange before you can realize any kind of profit or loss from your position. So when someone is taking coins off the exchange, that is saying we don't have any desire to move these elsewhere for the time being. The balance on exchanges was in a perpetual non-stop increase for about 7 years, from 2013 all the way until 2020. This moment here on March 14th was a moment of liquidity crisis in the markets, both in the equity markets, the bond markets, and in Bitcoin. There was a big sell-off, and since this day, a transformation occurred in the behavior of hodlers on-chain. A couple of our core supply metrics shifted in this moment, and they have not turned around since. Exchange balances have been on a perpetual downtrend ever since mid-March. Let me zoom in here. You can see we've had a couple of increases. There was an increase here during the sell-off in May as people put coins on their exchange to get rid of them. And the balance kind of held steady here while we were accumulating. People are putting them on, some people are taking them off. This is a net gain metric, right? Every day, some people are putting some coins on the exchange, some people are taking them off. But net gain, this was relatively flat for most of the summer and then resumed the decline as soon as price began to appreciate again. As soon as gains start being realized, people who hold coins are putting them in cold storage. They're taking them off of Coinbase. They're taking them off of Binance. They're taking them away from the hands of would-be buyers. The next thing I want to look at, this is liquid supply. So we speak a lot about illiquid supply. Illiquid supply is the amount of coin sitting with people who statistically do not sell. For a coin to be illiquid, it needs to be sitting with an entity that has a history of selling less than 25% of their Bitcoin over their lifetime. The converse of illiquid supply is liquid supply. So these two values here, liquid and highly liquid, the red and the orange, combined represent the amount of supply that sits with people who are more favorable to the idea of selling. Maybe they're day traders, maybe they're swing investors, maybe they're just people who don't have confidence in Bitcoin like we do. Whatever their motivation, whatever their bias, they tend to sell and transfer their coins in and out of their wallets more frequently. The liquid types do it from 25 to 75% of the time, and the highly liquid types, here in red, they sell 75% or more of their Bitcoin. They may buy more, but then they'll sell 3/4 of it at some point. So there's a constant in and out flow of these highly liquid entities and their supply. The Bitcoin that we consider to be liquid, to be moved more frequently, was growing basically since inception until this moment here, which funny enough is the same moment when exchange balances began to reverse. This liquidity crunch, this crash here in March of 2020 related to the C-19 lockdowns and all that stuff that happened, all the economic woe that happened in that spring of 2020. Bitcoin saw a liquidity crunch just like every other asset. And after that, the people involved in this market changed their perspective about Bitcoin. The hodlers always existed. The long-term maximalists have been there. But the less committed investor became aware of Bitcoin's properties at this time, and they began to hodl. And we can see that liquid supply and highly liquid supply have been in a structural downtrend since March of 2020. Just like our exchange balances have been in a structural downtrend since March of 2020. With supply, structural downtrend. These are both showing an intense hodler dominance. This value here of liquid supply is only about 23% of all Bitcoin, which means that more than 3 out of 4 Bitcoin out of all in circulation are sitting with somebody who doesn't want to sell it. That screams bullish behavior to me. And in every previous bull run, liquid supply has continued to increase, no matter what is going on with the price. The structural incline, the structural growth of liquid supply remained intact. There was a bit of a moment here in 2016 where it started to flatten out, but then it started growing again. Even in the bear market of 2018, liquid supply was growing, and it really started to turn around here, March of 2020. Since then, it hasn't looked back. This is less and less supply being readily available by eager sellers, combined with a reduction in the amount of coins sitting on exchanges easily purchasable by buyers. Both of these scream about an underlying bullish dynamic in the supply. And it makes it harder and harder for me to entertain a proper bear case when I see these metrics. Because think about the psychology of this. These people who are making up this liquid supply, they have experienced so much emotional turmoil as a Bitcoin holder in the year 2021. You kidding me? The amount of crap that they've gone through. First, Tesla says they're going to take Bitcoin for payment. Exuberance. Then a few weeks later, a couple months later, they change their minds. Terror. China announces they're going to get rid of industrial mining. Terror. We lose 70% of the hash rate. All of a sudden, the world is concerned that Bitcoin uses too much energy. Fear, terror, sell out of Bitcoin. It's all going down. A lot of FUD about Tether, the stablecoin, and the amount of reserves they have and whether it's a stable asset. FUD about U.S. regulatory uncertainty. People like Elizabeth Warren coming out and calling us all shadowy supercoders and saying that we're funding criminal enterprises. Every possible negative narrative you can come up with has been thrown at the Bitcoin market in the last 9 to 12 months. And yet, people in this market continue to take coins off of exchanges and put them into the hands of people who don't want to sell them. This dynamic was not present in previous bull runs. It's the opposite. It's a more supply constricting dynamic. So it makes it hard for me to feel that this market is going to suddenly roll over and realize new lows. Because for that to happen, many of the people that are statistically not sellers would have to begin behaving differently from the way they always have. And for that to occur, a major black swan type event would need to occur, or Bitcoin would need to change the rules of its protocol in some way so that its holders lose confidence in its future potential. That doesn't seem likely to me. Another chart I want to look at to help reinforce this concept of now being different. This is miner net position change. So miners are a source of constant sell pressure on the Bitcoin market. They have to sell some amount of their coins in order to remain profitable and functional as a business. They are investing hundreds of millions, in some cases many billions of dollars into infrastructure because they are businesses with 10, 15, and 50-year time horizons. Typically, in previous bull runs, miners were a source of heavy sell pressure. If we use the 2017-2018 bull run as an example, these red values here indicate when miner supply is net negative over a 30-day period. And the green represents when their supply is growing, when they are in aggregate stacking coin rather than selling coin. You can see here as the price begins to appreciate and take off, the rate at which miners are selling begins to increase. You see less and less green here, more and more red, till eventually it's just all red. This whole area here is just all red. And here, this is just miners selling. And there's waves of it. They sell into these peaks and then they hold off, and then they sell into these peaks and they hold off. This is a normal dynamic in bull runs, and it's something you'd expect to see from a business whose profitability is based on the production of these coins. But look at the 2021 bull run compared to the 2018 bull run. Look at the amount of miner selling heading into the blow off top compared to how much of it was over here. Miners are not selling like they were before. There was a burst here. This was their only true profit realizing wave in the 2021 bull run. This moment here in January and February. And since then, there have been a couple of pockets. They sold a bit here in the middle of the summer when things looked really uncertain, and there was some selling here. And both of these sales could be attributed to the fact that China banned industrial mining. 60-70% of the total hash rate was taken offline, and all these miners had to move to other countries to set up shop again. Some of them were forced to sell to help cover those costs, and that's partly what we see here. But everyone else who remained on the network and operationally mining, those miners became extremely profitable, and those miners are stacking coins. Additionally, many miners now are able to get operational financing through the lending markets, which means that they don't have to sell their Bitcoin in order to make a profit and pay their bills. Some miners, like Hut8, have a philosophy of hodling as much as possible, which is a different kind of miner than we used to have. And I think as price continues to appreciate and these miners become more efficient in the way they run their businesses, we might see an increase in the amount of miners who hodl as a priority. But with all that said, the point of looking at this chart was really to show you that the trend of miner selling is quite different from it was the last time we had a bull run. There is a lot more stacking going on and a lot less sell pressure. If I show you the total miner balance, this is the amount of Bitcoin in all miner wallets. structurally on a decline for years as miners were net sellers. They tended to sell more than they held. Well, something changed here in July 2019 and January 2020. I haven't done enough research to be able to explain to you all of the factors that might have contributed to miner economy kind of reversing and miners becoming more able to withstand turns in profitability, to remain more resilient, but it's clear that their balance is now on the net increase. There's a bit of a wash here. This was that moment where they had a lot of selling. Right here, as we broke the previous all-time high, pushing up to 40K, miners sold a grip. There's been a couple of other little pops here and here, but mostly it's been growing since late 2019, which is very different from the past. So this is another new wrinkle in this market that was not present in previous markets that makes it harder for me to make a proper bear case. This market just doesn't look the same. There's one other metric I want to look at, and it is based on the realized cap HODL waves that we talked about in the previous video. I'll leave a link to that in the description if you want to learn more. But basically, this is showing us the distribution of supply weighted by the time that coins last moved and their realized value on chain. So it tends to ignore very old coins and coins that have never been moved from their initial position. There is a metric that is built off of this concept of HODL waves that helps us to visualize the shifting market psychology from newer and older hands as the cycles play out. And what it is a ratio between the 1 day and 1 week coins and the coins that are 1 to 2 years old. This represents short-term investors and long-term investors. It represents people who are new to Bitcoin and folks who have likely experienced at least a partial cycle at this point. It represents high time preference and low time preference. And as you can see just from the two colors here, there is a cyclical behavior. In bear markets, the 1 to 2 year coins grow in size, and during bull markets, they are distributed back into the younger coins, which become 1 day, 1 week. And the dominance of 1 day to 1 week coins becomes higher as we reach the tipping point of bull markets. Same pattern played out over here in 2018. This ratio of these two groups is something called the RHODL ratio, or the realized HODL ratio. This was first put forward by Philip Swift, aka Positive Crypto, another analyst in this space who does a lot of great work. And they also have the website lookintobitcoin.com, which I'll leave a link to in the description if you want to go check out some of their charts. So this RHODL ratio is showing you the weighting of young coins versus old coins by looking at the groups between 1 day and 1 week and 1 year and 2 years. The observation of this oscillator here is that as price appreciates in a proper bull run, the weighting of younger coins begins to grow. That is, older coins are being sold, which restarts their lifespan over at 0 and makes them by default a young coin. And as that happens at greater rates, as price is growing, the younger coin bands adopt and absorb more of the supply. And that's how you get these spikes in value. And then in the bear market, as younger coins tend to reduce in their dominance and the hodling behavior tends to take over and coins mature into the 1 year and 2 year group, we start to see this value go down. And it tends to bottom out in the basins of bear markets, when young coin activity is at its lowest and when the maturation of coins is at its highest rate. There's one thing about this oscillator that I really like, and that is how accurate it has been at timing market peaks. A lot of the oscillators that we use try to time market tops and market bottoms. Some of them are good at it, some of them are not. This one is very accurate, and I think it's because of the absolute nature of the underlying market psychology that produces a proper bull run. Each market top has been timed by this oscillator within about a week or so. It's very good at pinpointing the moment when coins begin to shift hands from young to old, when the trend begins to reverse. It tends to be when price begins to reverse. So why am I showing you realized HODL ratio today? Well, we've established that this is a pretty accurate oscillator. It seems to time market tops very well, and it also does a good job of showing the transition of coins from young to old hands, which is a natural behavior in every bull market cycle. Something I want to note about the realized HODL ratio is the way it looks now. You can see in every market cycle there is a steady growth of coins from old hands to young hands until it reaches an apex and it rolls over. And this oscillation back and forth happens reliably through all market cycles. And with each cycle, the process has gotten a little bit longer and more protracted as this asset grows exponentially and more capital is needed to move the needle. Currently, realized HODL ratio is still on the increase. We did not have one of these watershed moments where young coins adopted most of the old coins and there was a reversal. Young coins adopting old coins and then a reversal. Young coins adopting old coins, a bit of a flush back down, but this trend resumed the exact same structural angle that it had been on since 2019. Do you see this? Let me zoom in. This value is growing. This is showing that 1 day to 1 week coins are adopting a greater portion of the volume as we continue to appreciate in price. As we hit this initial market peak in January, this value saw a quick spike, and through the initial part of the rally, there was a bit more chop. But since then, we've seen a decline and has now found a resting point here in this area, which is structurally on the same growth trajectory that it has been on throughout this entire market cycle since January of 2019, when the real bottom of this market came in. That was the low for realized HODL ratio. And we have not seen a proper changing of the guard, a proper handing off of the baton from young coins to old coins the way we need to see to signify that this market cycle reached its true apex and it needs to turn over. I like this metric because it doesn't have a lot of assumption built into it. There isn't a lot of noise. It is factually observable data. Coins that live with younger hands that are only 1 day to 1 week old, coins that live with older hands, 1 year to 2 years old. The market psychology that is rolled into those two groups is distinct and consistent. Younger hands have a higher time preference. They have less market experience. As a group, they have less market experience, and they tend to get more of the supply at the tops of markets. Conversely, older hands tend to be more experienced investors. They have a statistical likelihood to continue hodling, and they tend to absorb more of the supply in bear markets as younger coins become less interested in transacting. When I look at the trend of realized HODL ratio right now, to me, this looks very much like the 2013 market. We had an initial push up, and then there was a bit of a reset where some old coins were realized and they were sold off to new hands, but it wasn't really a full exhaustion of that market. And then, several months later, there was another bull run. I feel like we are in a protracted version of this market here. And I've made this case before on this channel using other metrics that I believe we might be a double pump situation, the double pump market of 2013 and 14, but on a longer time scale. And this is one of the reasons I believe that. As long as we continue to see this value growing at this same rate that it has been growing at for now 2 years, despite all of this going on, despite the C19 crash, despite Tesla FUD, China FUD, mining FUD, energy FUD, regulatory uncertainty, all of that crap, despite all of it, this value is still trending up like we're heading towards a proper bull run. Just something to consider. One metric does not assess the entire market, but when looked at in tandem with a host of metrics like we're looking at today, we can get an idea of what this market looks like underneath. The people who hold Bitcoin, that have held it all year long, have absolutely no reason now to sell. Many of them have a statistical history of not selling, and they now hold almost as much coin as they have ever held relative to supply. When I combine something like this with the fact that exchange balances have continued to go down, less and less coins are available for sale. Less and less coins are being held by entities with a propensity to sell. Miners are not finding as many reasons to sell as they were at previous bull runs. And the volume of supply that is held by young hands is nowhere near the levels it needs to be historically for us to say that this market has exhausted itself. And it remains in a structural growth pattern, a 2-year structural growth pattern. Finding it hard to be a bear, folks. I'm really trying here. I'm trying to peel back the onion as much as I can. I'm trying to look for all of the places where I find weakness in this market. And the only place I'm finding weakness right now is in the short-term price. So that's what I see right now. I appreciate your patience with me the last few days, as I took a bit longer to put out this video than I wanted to. I lost my father to cancer a couple of days ago after a 10-year battle, and it's been a bit of a stressful weekend for my family. But talking about Bitcoin and thinking about the future helps to keep me grounded, so I appreciate you continuing to support my channel and watching these videos. Be sure to follow me on Twitter at TXMCTrades. I post a lot of observations, and you'll be able to find out about other content I'm getting involved with, whether it's through Glassnode, going on some podcasts, whatever's coming down the road. Make sure you leave any feedback in the comments for how you feel I can improve, or any questions you might have about topics that I didn't explain clearly. This market continues to look strong. The short term is uncertain, but the underlying supply is telling a macro bullish story that is different from previous bull runs. Do not be swayed by short-term negative news, because negative news for Bitcoin has a tendency to turn into positive news. Just need to lower your time preference. With that said, I'll let you guys go. We'll speak again very soon. Take care of yourselves, friends. Cheers.